All right, let's talk about banking. We're going to pull back the curtain on this world that we all use but maybe don't fully understand. First, we'll look at this incredible push to get everyone a bank account. And then, we're diving deep into the hidden, high-stakes risks that banks are dealing with 24/7 just to stop the whole thing from crashing down. Sound good? Let's jump in.
So, you've got a bank account, right? It feels pretty simple, an everyday thing. But behind that little card in your wallet, there is this massive, incredibly complex story. It's a story about inclusion, about innovation, and, believe it or not, about a huge amount of risk. And it's a story that affects not just you, but the entire global economy.
So, where do we even begin? Let's start with how we got here. How we reached a point where having a bank account became a real possibility for pretty much everyone in a country as huge and diverse as India. It all kicked off with one simple but really powerful idea.
Let's rewind to 2005. The big idea was something called a no-frill account. Now just imagine Ramesh, a daily wage worker. For him, coming up with 1,000 rupees just to keep a bank account open was basically impossible. This new account, it was a total game changer. It let him open an account with zero balance. All of a sudden, he had a safe place to put his earnings. This was a massive first step, and honestly, it paved the way for something even bigger. You know, that one little idea really started to snowball. It grew into a whole range of different accounts, each one tailored to what different people actually need. It was all about flinging the doors to banking wide open for millions. Let's take a look at how that system works today.
So, that old no-frills account, it grew up. It evolved into what we now call the BSBDA, which stands for Basic Savings Bank Deposit Account. You can think of this as the modern standard for easy access, zero-balance banking, and it's packed with some really essential features. And these features are super practical. Think about someone like Meena. She can walk in, open a BSBDA, and she gets a free RuPay debit card. She can deposit money as many times as she wants, and she can take cash out up to 4 times a month, all without ever having to worry about keeping a minimum balance. It's the perfect on-ramp to the whole formal banking system.
Then, in 2014, this whole effort shifted into high gear. It went from just being a banking policy to a full-blown national mission. This was the Pradhan Mantri Jan Dhan Yojana, or PMJDY. The goal was huge, but it was simple. Make sure every single family in India has at least one bank account.
And the benefits here are just wow, they're really powerful. Let's imagine Savita, a housewife in a small village. She gets all the stuff we've talked about, zero balance, a debit card, but on top of that, she also gets insurance coverage and, this is the big one, access to a 10,000 rupee overdraft after 6 months. Now that overdraft isn't just a loan. It is a critical safety net for emergencies. For someone like Savita, that's absolutely life-changing. Okay, but what about people who don't have the usual ID or address proof? You know, like migrant workers who move around for jobs? Well, that's where the small account comes in. It's basically a temporary on-ramp to the banking system designed to get you started while you get your documents in order.
Now, this account does have some guardrails. Let's take someone like Rahul, a migrant laborer. He can't keep more than 50,000 rupees in it, and he can't deposit more than 1 lakh over the whole year. The account is only good for 12 months, which gives him time to get his full KYC sorted. See? It's not meant to be a permanent solution. It's a bridge to get Shu to full financial inclusion.
So opening an account is way easier than it's ever been. But what happens when the bank messes up? What if a transaction goes sideways and you feel like you're hitting a wall trying to get help? Let's look at the system of accountability that's supposed to have your back.
The good news is there's a clear process. Let's say Priya deposits a check, and it just vanishes, never gets credited. Step 1, she complains directly to her bank. If 30 days go by and there's no solution, she can escalate it, for free, to the banking ombudsman. They'll investigate, and if they find the bank was wrong, they can order them to pay up. It's a really powerful tool for protecting you, the customer.
Okay, now we're going to pull the camera way back. We've been looking at the individual experience. But to keep everyone's money safe, banks are constantly walking through a minefield of hidden risks. This is the other, much scarier side of the banking story.
The giant umbrella term for all these dangers is financial risk. At its heart, it's just the chance that a bank could lose money. A really stark example of this was Yes Bank. They gave out these enormous loans to companies that were already struggling, and when those companies couldn't pay them back, well, that potential risk became a very real, very massive problem that nearly took the whole bank down. Now, within that big category of financial risk, there are 2 types that are absolutely critical. First, you've got credit risk. This is what happened with Punjab National Bank and Nirav Modi. It's when the borrower just plain doesn't pay back the loan. Simple. But then there's liquidity risk, which is a totally different beast. That's when a bank doesn't have enough ready cash to give depositors their money when they ask for it. Think of the panic during the 2020 Yes Bank crisis. So, one is about getting your money back eventually, the other is about having the cash on hand right now.
Next up is market risk. This is the danger that just comes from the financial markets being so unpredictable. So imagine HDFC Bank invests a ton of money in government bonds. If interest rates in the market suddenly shoot up, the value of those bonds can just plummet, and boom, the bank takes a huge loss. It's got nothing to do with who they lent money to, it's just the wild ride of the market.
And that leads us right into interest rate risk. Say SBI gives out a bunch of home loans at a fixed 8% interest. But then the central bank raises interest rates, and now SBI has to pay its depositors 7% on their savings. All of a sudden, that healthy profit margin gets squeezed down to almost nothing. One small change in the national interest rate can have a gigantic impact on a bank's bottom line.
Then you've got operational risk. This is the risk of things just breaking. It could be a software glitch at ICICI Bank that sends money to the wrong account, a dishonest employee, or even something as basic as the entire ATM network going down. It's the risk that the internal machinery of the bank itself just fails.
And all of this leads to the mother of all risks, systemic risk. This is the nightmare scenario. It's the idea that the failure of just one huge bank could set off a domino effect, bringing down the entire financial system. The collapse of Lehman Brothers back in 2008 is the textbook example. One company's failure triggered a global crisis. It's the ultimate financial doomsday scenario.
And finally, there's reputational risk. You know, at the end of the day, a bank runs on trust. It's everything. When Wells Fargo in the US got caught creating millions of fake accounts without customer permission, its reputation was absolutely shattered. Customers left in droves. See, a bank can survive losing money, but it cannot survive losing the public's trust.
So when you put it all together, what you have is this constant high-wire balancing act. On one side, you've got this vital mission to bring every single person into the financial system. And on the other, you've got the immense responsibility of managing all these crazy, complex risks to keep the whole thing from falling apart. It's a real tightrope walk.
And that really leaves us with the big critical question. The push for total financial inclusion and the absolute need for stability. Sometimes those two things pull in opposite directions. So the real challenge for all of us moving forward is this. How do we keep innovating and opening doors for everyone while making sure the very foundations of our financial world stay rock solid?